What would the Fed funds rate need to be for the S&P to touch 7,000 points?
Oh, it doesn't have to move. Like, we're on our way
Really?
there. Yeah, like I think a year from now, you're talking about S&P 7,500.
Our next guest has correctly called the bull rally on the markets, and the bull rally is not over yet, according to Mike Lee of Michael Lee Strategy. Welcome back to the show, Mike. Congrats on your calls this year. Good to see you again.
David, thanks again for having me back.
Yeah, CoreWeave was one of your calls that you made on my show last time. People can check out what you said. We'll play a clip for the audience.
Okay, what CoreWeave does is they stand up data centers. They buy a bunch of NVIDIA GPUs, they put them on server racks, and they rent them out for companies to run their AI projects. Their biggest customers are Google, Microsoft, Facebook. The street is confused about the business model. They don't think this company is going to keep growing, but let's just take a step back. In 2023, they did $230 million in revenue. In 2024, they did $1.8 billion. In 2025, they're going to do $8 billion. Next year, conservatively, $12 billion in revenue. I think the number is going to be more like 16 or more. Okay. It's trading at about 5 times revenue, 5 times earnings in a very conservative manner. I think this stock is a 4 to 5x over the next 18 to 24 months.
But we'll revisit that, other tech stocks in your current holdings lineup, and more importantly, your broad market outlook. So you were telling me offline your notes that people shouldn't be selling on new highs. Well, that's where we are right now. Why not?
Yeah, look, you never sell new highs. Like, it's, that's like one of the mantras of the founders of Investor Business Daily. And, I have a friend that puts out a note every day, who was the head of trading for George Soros. That was one of George Soros' mantras. Never sell new highs. Never, ever sell new highs, right? And you have to ask yourself, like, what led us to these new highs, what's likely to happen in the future, and what's likely to change. And so it's just this my other technical friends say, I don't want to buy low and sell high. I want to buy high and sell higher. So we have this enormous momentum factor behind us right now, pushing markets higher. Maybe we're a little bit stretched and you get another opportunity to get in some more. But this is another hated bull market, bull run. A lot of people waiting for some shoe to drop under the false belief that tariffs will somehow cause a recession. Just total and utter nonsense, in my opinion. And if you look at some of the technical factors we've seen, so you've got the 50-day and the 200-day for the NASDAQ giving us a golden cross last week. You have the S&P 500 moving 20% off its low in an extremely short period of time. Both of these historical trends have led to, on average, 20+% returns over the next 12 months. We just got a massive fiscal stimulus package. Okay, and before everyone talks about the deficit numbers, realize what the CBO was talking about is if you let every single tax cut from 2017 expire, they guesstimated how much additional revenue that would have created. So that CBO number is total and complete nonsense. So we basically kept everything in place, okay, with a few small changes around the fringes, noticeable changes or for overtime and for tips if you make under 150,000 single or 300,000 married. So that part of the population is going to get a nice tax break. But more importantly was the immediate depreciation of plant equipment. And so when you're trying to drive manufacturing onshore, you now have a low corporate tax rate. You're going to get some deregulation. You're trying to attack the cost of energy from an energy standpoint. And now this tax favorability for this investment in plant equipment is going to make a meaningful difference throughout the multiplier in the economy. Okay, also, we have these things called interest rates, which are way too high in the U.S. There could not be more pressure on Jerome Powell to cut them now. And even if he doesn't, we're going to have a new Fed chair inside of 9 months. So, rates a year from now could be 250 basis points lower than where they are today, but in my opinion, at least 150 basis points lower. Okay, and you have earnings estimates that are way too low. So you're likely going to get companies that beat earnings estimates. You just got some fiscal stimulus, which is about to kick in. We're going to get monetary stimulus. Okay, you're going to get deregulation coming down the pipeline, and you have this momentum factor behind you. So look, it's the easiest sign, like Occam's razor. What's most likely to happen? Stocks are probably going to be up 10 to 20 to 30% over the next 12 months.
Without any particular catalyst, just the natural progression of everything you've talked about?
Well, we just so you haven't had the rate cuts yet, and you haven't had companies beating earnings estimates yet. But these are so the potential catalysts I see are the knock-on effects from this fiscal stimulus. So you're going to get data points coming out higher than expectations across earnings as well as hard data in industrial production, durable goods, these sorts of things increasing much faster, which can be a knock-on effect of GDP.
Mm-hmm.
So better economic growth than forecasted, better earnings growth than forecasted, plus a much better interest rate and liquidity environment. And then, oh yeah, there's this thing called artificial intelligence, which the market still doesn't have its arms around, which brings us back to CoreWeave and why people just didn't get the name. I still don't think they get it. Um, and it's why a company that's in all likelihood going to do 12 to 15 billion in revenue next year, probably closer to the high side, which means they're going to make between 7 and 8 billion in gross profit before they go out and reinvest in their business. But you're not probably be trading at a 25 to 30 multiple on top of 8 billion. So $160 billion market cap conservatively, and it's at 70 or 80 now. So like I mean, this is the runways in front of them. And then you go out 2 years, this company could do 20 something billion in revenue. Again, 65% gross margins. And you're not going to get the same multiple off a gross margin as a net margin. And yes, I know they lose money, but that's because they take every dollar they make and they lever up to buy more NVIDIA GPUs and build more data centers. And this deal they just did with Core Scientific, they own a lot of data centers that CoreWeave is paying to co-host on, and it's going to save them 10 billion in rent payments over the next decade. Plus, Core Scientific has their own business, so they're buying the stock, which is in my estimation, probably I would have liked to see them pay cash, but I'm sure their bankers have their own reasons to do that. But it's like, and that leads to the broader picture that the market on a whole does not understand the infrastructure needs for artificial intelligence, and how big this is, what the growth is going to look like, the impediments to growth, and how that's going to propel the market because the biggest players in AI infrastructure are the biggest biggest weightings in all the indices. So if these companies are crushing estimates and doing well, the whole market's going to do well.
Yeah, you were on the show mid-May, last time you were on, so almost 2 months ago. Since then, let me just share a screen. There's a chart of CoreWeave. Stock's up about 170% since you've been on. Actually, more than that, depending on which date you started at. But yeah, about 208. Okay, never mind. 289% since you've been on. That's not counting the highs. So yeah, good call there. I mean, at what point does it become enough? Like valuations overstretched, you should start taking profits. I mean, that's what people might think looking at this chart. Yeah.
So let's just say you bought it on the high side the day that I was on at 75, and now it's sitting at $1.50 and you've doubled your money. Okay. Depending on like what your investment, like what your goal is, like if that was a trade, if you bought 1,000 shares and you want to sell half now or three quarters now, fine. I would say that this is a company that you want to hold on for multiple years from here, and you're looking at many multiples in the stock price because to understand artificial intelligence and the infrastructure that needs to get built, the unit of measurement for AI is tokens, not tokens like cryptocurrency, but tokens is about 3/4 of a page of language. Okay, the growth in token use for AI exceeds the growth of infrastructure build out. And like you're talking about hyperscalers spending tens, if not hundreds of billions of dollars a year building out the infrastructure. And it's just not enough. Like you have these exponential curves of investment, but a faster exponential curve for token growth and the demand for tokens, because we are just at the LLM stage. And so next after LLMs, you're going to have all the agent stage, which is the agents putting all these LLMs into use across the business models. Okay, that's going to require an enormous amount of tokens. At some point, you're going to get there where the infrastructure growth needs to be mid to low single digits on an annual basis, which is kind of where we got to with the internet in like 97, 98. Okay, that's the chart of NVIDIA and Cisco where you can see them like each other. We're not there yet. The quickest we'll be there is 5 years if there's no impediments for data center growth, for GPU production, or for energy grid availability. There are huge roadblocks for all of them. So the token growth is going to exceed infrastructure availability for at least 5 years, could be a decade, which means all of these companies are going to have unbelievable pricing power, double
Hmm.
digit, 20, 30% growth on an annual basis, which plays for like the Microsofts, the Googles, the Amazons, Broadcom, NVIDIA, Marvel, AMD, CoreWeave. Like all these companies have such huge just so much roadway in front of them
Sure.
to make money where you're looking at this 25 to 50% earnings growth based on the company. That's why I believe in CoreWeave, because all CoreWeave does is they are a pure play cloud provider. And so if you're buying Microsoft for their cloud growth, why not just buy the cloud growth?
Well, that's my. So I've two questions on CoreWeave. So the risk here is that there's nothing unique about what they're doing. Like there's no IP proprietary stuff here that they have that nobody else can do. So they own data centers. They provide cloud computing. So does Amazon. So does IBM. So does Microsoft. What's stopping the clients of CoreWeave, many of whom are the big seven tech companies, to just do that on their own without having to outsource that?
NVIDIA GPU availability. That's how scarce the resource is. You have a scarcity of resource. Also, CoreWeave solved something called the cold boot problem.
Hmm.
So the cold boot problem. So if you're renting GPUs by the hour, it takes anywhere between 10 and 20 minutes for them to fire up those GPUs. So if you're renting them for 2 hours or 3 hours or 4 hours to run your LLMs on, you don't want to pay for that dead time. So CoreWeave has solved that cold boot problem, but it's like, look, you're in an arms race, and CoreWeave, NVIDIA needs to diversify their customer base. If they wanted to, they could sell every single GPU they possibly make to Meta. Okay, but they don't. They break it up, and I believe CoreWeave is number seven in terms of their customers, in terms of size and the GPUs they can get their hands on. Like you just, and you need to understand this, that if you're GE Vernova and you have all this medical data, okay, you want to go ahead. You're going to be the leader in AI for healthcare because you have so much data. All right, you can't build your own data center because you can't get your hands on the GPUs. I mean, you can try, but that's how finite these resources are. Like, you need to pay someone else to get their hands on the latest and greatest NVIDIA GPUs, or from AMD or Broadcom or Marvel or whoever, because, like, it's again, you go back to this 15-to-1 relationship. So for every GPU NVIDIA sells, there's demand for 15. So
Hmm.
this infrastructure build out is just so much bigger than the street has their arms around. And to me, the realization at some point by broader Wall Street of how big this is going to be is where, like, the trade comes from. Yes, it's good to have 25, 30, 40% earnings growth, but the realization that like a Marvel or an AMD shouldn't be trading at 15 times next year's
Yeah.
earnings, like they should be trading at 30. Like, what that realization trade is going to come into effect at some point, and all these stocks will see a substantial pop, and then from there you'll be married to the earnings growth like normal stocks. But that to me is where like the opportunity lies in like a lot of these hyperscalers and the picks and shovels in the AI space, if that makes sense. So CoreWeave, yes, like they just it's finite, the resources that they have, and at some point, yes, the music will stop, but that could be a
Well,
decade from now.
by the way, just yesterday they announced a $9 billion deal to buy Core Scientific, which is a crypto miner. Correct me if I'm wrong. Correct me if I'm wrong, but I believe CoreWeave started as a crypto miner and then transitioned over the years as a cloud computing provider for AI services. Now, I wonder if that's a natural progression of crypto miners. One of the questions I keep asking crypto miners when I interview them is how they can expand their revenues way into the future when Bitcoin is finite. Eventually, there's going to be no more Bitcoin to mine by 2140, right? So I wonder if this is the future for Mara, for Riot, and all the other big crypto miners out there?
If they could get their hands on more NVIDIA GPUs, like again, if they can get their hands on the equipment and use their existing data center infrastructure to host cloud computing for AI, yes, that would be a brilliant idea. And that's all this is CoreWeave rents. They're going to save $10 billion in rent over the next decade because they're a lot of their GPUs are co-hosted in core scientific data centers.
Okay. What
So,
else is in your tech hold? Sorry, I'll let you finish. Yeah.
yeah, but like it's hard to get your head around such a finite resource, right? That you think like because at no point other than during like COVID when nobody could get processors to build anything,
Yeah.
um, it's the only other comparable situation where there's everyone wants to do all these things with AI, but all these GPUs are so finite that there's just not enough infrastructure, and it's going to take the market's predicting like a 12 to 18 month before you have excess infrastructure, and infrastructure growth is going to fall off a cliff. That's really like 5 to 10 years from now, in my
Okay.
opinion.
So you've got other AI stocks in your list of picks. Microsoft, Amazon, Google, Oracle are your mega caps. Semiconductors, Nvidia, among other ones. Enterprise, Palantir. We'll talk about Palantir in just a minute. Okay, so are you just buying the Nasdaq index now? Because that's, I think, the majority of the index market cap, if I'm not mistaken. Or are you
No, no,
selecting those companies in particular?
I'm buying those names because like you're gonna get dramatic. Like so, Google's like unbelievably cheap at this point. Google's got a lot of different businesses, and there's questions over the viability of search going forward. I believe Google will figure that out. Um, Google also, their Gemini AI product, like they really fell flat in its face. But like if you think about all the data that Google has from search to be able to build themselves what could be an unbelievable competitor to XAI, to ChatGPT, to Anthropic, they will get there. And if you look at the multiples that all these other companies are getting, plus they're not getting any reward in the stock for Waymo and their self-driving technology. And look, I believe Tesla is going to smoke them when it comes to self-driving, simply because the Tesla auto robotaxis cost like 25 grand to build. The Waymos are a quarter, they're 250,000, and it just a lot more driving data. Like it's all the data feeds into the AI, and so Tesla has cameras in everybody's car that they can feed into feeding their AI machine, which is going to drive their self-driving. But anyway, it's Google's like the easiest double over the next 12 to 24 months that I've like ever seen. Right?
Hmm.
You need to get some overhangs out of the stock, and then it's going to explode. So that's the cheapest out of that. But the way that you think about it is like think about a pyramid, okay? And the fat part of the pyramid is where all the money's being made. And at the moment, that's the infrastructure and the hyperscalers, right? It's Nvidia, it's Microsoft, it's CoreWeave. All these companies are at the bottom, and at the
Yeah.
top, you have software. At some point, that pyramid's going to be upside down, where all the money's at the top, right? And so that ties us into Palantir. And so Palantir is trading at an obscene valuation, right? You're at 60 times revenue. The stock at the moment, they're going to do about $5 billion this year. They're at 300 something $1 billion market cap, which
Is it a
is
tech play or a
probably
defense play on the war in the Middle East for you? What's this thesis there?
it's both. So Palantir is the most consequential enterprise software ever created, right? It's going to go beyond where Windows was. And let me explain to you why. So their software can go in and sit on top of any system. So if you're creating LLMs and you want to have your agents implemented in different business units, if you've ever gone through a large systems integration, it's a nightmare. For me, that's when Morgan Stanley merged with Smith Barney. It was a disaster. It took 3 or 4 years, and it never really resolved itself. So to have a single software that can sit in and see data in every part of the organization and implement automation and change in a matter of weeks, there's never been anything like it. Okay, and it's a 20+ year overnight success. And so, in the age of AI, how are you going to get all these AI ideas to work throughout your enterprise? There's only one solution now, that is Palantir. And oh yeah, you look at what's going on in the war right now with in wars right now with defense and drones and the use of AI and predictive analytics. Again, you Palantir is alone in their implementation. So the way that you need to think about Palantir is this year you have roughly a $60 billion addressable market for AI software. Palantir represents an 8 to 9% market share of that 60 billion. That is going to be a $1 trillion market in 2030. If Palantir maintains the same market share and goes from 5 billion in revenue to 70 or 80 or more or a little bit less, okay, you're going to get a 20 multiple to that, which puts you at somewhere between like a 1.4 and 1.8 trillion dollar market cap, right? And that's massive multiple compression throughout some of the most explosive growth any software company has ever seen. So even though Palantir is super expensive, there is so much upside and there is zero competition for what they can do.
Okay. I want to just draw your attention to this S&P 500 PE chart. Just going back to your overall market view. I mean, this all sounds great. I'm buying your thesis. Let's say someone says to you, Mike, I'm buying your thesis for Palantir, Microsoft, Google, CoreWeave, but just overall, I haven't gotten into the market yet. Like, I'm out. I want to get in because I believe what you're saying, but I'm just looking at this chart. This is the most expensive the S&P's ever been since the great financial crisis in 2008, if you discount what happened in COVID, which was a glitch, right? So I don't feel comfortable getting in right now. How would you say to that?
So, so what I would say, are you on the Schiller PE or is that the forward?
This is S&P
Forward
500.
PE?
I think this is trailing. Yeah, trailing 12-month
Okay.
earnings.
Yeah. So, just like, yes, this, you can look at this chart, but like, let me ask yourself, when you look at stocks are a forward-looking instrument. Okay, just like when you drive a car,
Hmm.
I'm looking out. I check my rearview mirror occasionally, but like when I'm driving 100 miles an hour in my Tesla on Alligator Alley in Florida, where I live, right? I'm looking forward. Yes, I'm checking my rearview mirror for police, but I'm looking forward. Stocks are a forward-looking instrument, and so I do not drive my car in reverse. And so a trailing 12-month PE ratio,
Mm.
trailing 12 months of a company, I don't say it's completely useless, but it's pretty close. And yes, it's nice to buy stocks cheap, but the idea is that like
Mm.
you can wait to get in, but what like when is that going to happen? How many people who were waiting to get in that were 100% cash going into this year were buying stocks the second week of April? I think April 7th was the lowest. It just if you can time that market and you have that much discipline and you can get these trades where these horrific events happen, which seems like they happen like once every 3 or 4 years, good for you. I can't. I'm invested. I will take profits in certain things as they rally significantly. So CoreWeave, I was unsure about this merger, what that was going to do. Now I think it's a brilliant idea for them. It's going to work out spectacularly, and that you have such exponential growth for these companies that I like I don't think I could possibly be more bullish. Would I like to buy stocks cheaper? Yes. Would I like to buy everything cheaper, but that is not the world we live in.
Okay, fair enough. You said to me offline, or you wrote to me offline, that the Fed leadership is a joke right now. Okay, so investors are waiting for the Fed's next move. That could determine the direction of the markets. Where I think the bond market's pricing at what, 2 rate cuts this year. It depends on a lot of things, including inflation data, including what Trump is doing with tariffs. That's an unknown. We'll talk about that in just a minute. Policy uncertainty surrounding foreign policy with the Middle East, that could have an impact on markets. The Fed's kind of waiting for a lot of things. They're data dependent. How would you evaluate the Fed's actions? What do you expect going forward? Why are they a
You know,
joke? Is basically
you know,
my question.
yes. So the Fed can say they're data dependent. Like I can say I'm Superman. Like it's kind of holds the same weight. Like and like Bernie Moreno, senator from Ohio, just put it perfectly to Powell. It's like, look, when they shut down the economy for COVID, you made no comment. When the energy policy or the fiscal policy of the previous administration sent inflation through the roof. You made no comment. Okay, a couple minutes prior, you said that you should forgive all student loans, and then you want to stand up here and tell people that you're not political, and you go on and on and on about tariffs with no real evidence that they cause inflation. Like you think it might, and if anything, if it makes a difference to price, it's a one-time price shock. And so he is a hyper-partisan anti-Trump actor, right? And so he, he got referred by the head of the FHA or the Federal Housing Authority or
Mm-hmm.
HUD for perjury and congressional testimony. So we'll see if he serves out the rest of his term. But let's just assume that he does. We'll probably get 2 rate cuts this year. And then with the new Fed chair, you'll probably get like 100 basis points right away. Okay. And then maybe, and like, look, I can see if I'm the Fed chair and we're getting these inflation readings that are somewhere between 2.3 and 2.6, I'm keeping rates at 3%. Okay, I think Trump would like them closer to 2, but I'm a little bit tighter, and so I'm more worried about inflation. I think you should be restrictive if you're above 2% inflation. You shouldn't get to neutral until you're 2% and below. But that's like my opinion, and no one's making me the Fed chair. So rates are coming down. If in a year from now, there's a chance rates could be 250 basis points lower than they are right now, or 225.
Let me ask you this. Hypothetically, what would the Fed funds rate need to be for the S&P to touch 7,000 points?
Oh, it doesn't have to move. Like we're on our way
Really?
there. Yeah, like I think a year from now, you're talking about S&P 7,500.
Okay. All right. That's a good call. All right. Well, 7,500. We'll follow up in a year and see what happens, but we'll have you on before then. Fine. Okay. So the natural progression of things is bullish. What do you think the Fed is going to do? I mean, forget what you would do if you were the Fed chair.
Look, I think we get 1 or 2 cuts by the end of the year, right? We get nothing in July, and he's going to hold this data dependent. And if we start to get, like, it depends where these inflation readings come in. If we start getting sub 2% inflation readings,
Yeah.
maybe we get another 25 or 50 before Powell's gone. But that's it. You're getting at least 50 basis points by the end of the year, I think, unless we get some out of control prints, but it just doesn't seem like it. Like if we were going to see a heavy inflation print from tariffs, why haven't we seen it? You know what I mean? Like if this was going to happen, and if it's going to happen, it will be one time. So like I just don't see it because you have so many other deflationary things going on out there, and you haven't really gotten the effect from the EPA. And so in 2009, the Obama administration ran some study through in a few months that allowed them to regulate greenhouse gases. Okay, Lee Zeldin is going through the process of undoing that. Okay, once that goes away, it's going to take an unbelievable regulatory burden away from businesses in America. And so ideally you want things to settle down in the Middle East. And I don't know that you get sub 60 barrel of an oil, but you'll probably get close to there. Like the entire cost of energy countrywide and regulation countrywide is going to slowly but surely come down. You're not going to see the real effects of this tax cut until the first quarter of next year, but you will see it. Like all these good things are incoming. And again, you're looking at 4% growth of 4% year over year for this quarter of earnings. We'll see what happens. Like it's kind of fruitless to talk about what's going to happen next quarter because it'll move so much. But for right now, like we're not, like we are in good shape. Like it's one of the times where every time I look out, everything looks like it's really good. Maybe a little overextended in the short term, so maybe keep some dry powder. And if you don't want to pay up for some of these tech names, you can just write puts, right? So if these names keep, like, you want to buy them $5 or $10 below the market, so you write some Palantir 125 puts. Let's say for argument's sake, you get $5, your entry point's 120, and if it keeps running, you just keep the money. And like that's a way that I like to get into expensive stocks. For people out there who are trading, is just write puts 10 or 15% below the market, take the premium. If you get the stock there, you get the stock there because you want to own it. If you don't get it there, at least you have money.
Someone says to you, Mike, well, how can you be so bullish in a time so ripe with uncertainty? Just take a look at Monday, for example. This Monday, Trump just arbitrarily announced 25% blanket tariffs on Korea and Japan. He's not extending the August 1st deadline for tariffs anymore, or so he claims. And markets, the S&P fell about 1% just on that day in the news. And right now on Tuesday, we're speaking on Tuesday, it's relatively flat. So just surprise announcements can move the markets up or down 1%, mostly to the downside. How can we be so certain that this is going to happen again? I'm a little bit cautious as somebody listening to you. How would you respond to that?
Yeah, look, every time there's been a market sell-off on a tariff headline has been a buying opportunity.
Fair
So
enough.
literally every single time. So maybe there'll be an exception to that rule. You can tell me when that's it, but like these are all because like it's again the strategy here is to make it easier to export, start making more stuff, high value manufactured goods onshore, not the cheap stuff, but it's so then you start getting into you start addressing the deficit. Like we're annualizing at over $300 billion in tariff revenue right now before you've really stepped it up on certain countries.
Hmm.
Okay. Plus like you're spending less money, like the deportations are going to have a massive impact in terms of our fiscal situation. So the deficit spending is going to come down dramatically, which is going to get inflation under control, along with cheaper energy costs and deregulation, which is deflationary, which is going to lead to lower interest rates. And like, I don't know that it's being talked about, but it should be. Stop paying interest on excess reserve to these banks, allow them to lever up, get these take these tier one ratios we're demanding they have down, so you get more capital in the system. Um, like you're all the right things are happening other than the people who want to cry about tariffs.
Okay, fair enough. Um, okay, we'll look forward to seeing what happens next. Then let's see what happens with the next tariff announcement. But I mean, so far you've been correct. Buying opportunities happened after tariff announcements. So, do you hedge at all? Do you use any hedging strategies for? It
Yeah,
sounds like you're long. Yeah.
yeah. So long, but like in my core equity portfolio, I have a 10% position in gold, right? That like has kind of ticked up to 15. That I am like reducing. Like I'm a huge gold bull. Like my gold target is 5,000, and I'll own I'll own some other non-correlated assets in there. A friend of mine, Bob Elliott from Unlimited Shares, just launched a 2x global macro fund that I'll have in there, and then I'll have a cash position, and then I'm hugely overweight tech. So that's so that yes, like I have high conviction. But there are going to be some bumps in the road, and I need to take stuff down. And then, for conservative people, like we own conservative fixed income, right? Like I think the market is going to the moon. Yeah, you know what I mean? Like a solid 20% over the next 12 months. But in the event that I'm wrong, you always own things that are going to work regardless. And I think gold absolutely works regardless.
Is gold a diversifier for you or a hedge? How does gold fit in your portfolio?
A non-correlated asset.
Yeah, so it's a
That
diversifier.
yeah, yeah, non-correlation where I believe that it's on its way to 5,000, right? Like, and it's going to act independently of the overall market, right? So I want to, independent asset move in that direction, and then obviously, crypto. Uh, Crypto, I wouldn't call that as a diversifier. I'm a Bitcoin bull too. What you see a lot though is you see Bitcoin sell off with tech, and I think that's because you have similar ownership that's levered on both. And so when you have the market, when you have tech sell off or when you have Bitcoin sell off, people just creating capital in there. So it's a high degree of correlation between those two, highly correlated, more so than you would think. My opinion is they're so highly correlated because you have a very similar ownership that when you use leverage and that, and you get a pullback, people need to create cash. And like the one thing I failed to mention is you look at the net long exposure from Goldman Sachs prime brokerage data, you're still near 5-year lows, right? And it's all of these hedge funds, their money lines got cut. So even if you were a hedge fund doing well, okay, in that type of volatility from this tariff tantrum, people just took exposure down. And so they missed this entire rally. And so with more strength, you're going to see more strength because FOMO from the institutional investor blows away FOMO from the retail investor.
How do you feel about Bitcoin? Again, you're bullish in
Oh,
Bitcoin.
love
Is
it.
that a
Love
Nasdaq
it.
play?
Yeah, like I own it as a satellite to my core strategy, right? Where Bitcoin or where gold I own as part of my core strategy, if that makes sense. So Bitcoin is a satellite play that
Hmm.
that I'm going to own for years.
Can you
With
break down your rough allocation, stocks versus gold versus Bitcoin versus other alternative
Yeah,
assets?
so 32.5% in XLC, which is communication sector, 30% in XLK, which is tech, which is roughly a market weight, but I was underweight tech for kind of the last year. Then 10% gold, that gets me to 72%, 7.5% in the unlimited ETF, which is taking me up to 80. Then I own financials, XLF, because I expect that curve to kind of steepen. Industrials and consumer discretionary rounds out the rest of the portfolio.
Sorry, how does a steepening yield curve help financials again? Can you just explain that to us?
Oh yeah, because they pay you nothing on deposits and they lend long.
Mm,
You know what I mean? And so if it's
I
steepening from
see.
the front and coming down, probably the entire rate curve will most likely come down. But and it's like and then also you're going to see loan volume increase.
So
Which
you think
when
the 10 year is going to stay elevated even if the Fed cuts rates?
No, I think a year from now you could see a 350 to 375 10 year. Right?
Okay.
I don't think the market believes what they're going to see. I think once it becomes apparent that the front end is going to the 2% range or 2.5% range, you're going to see that 2 year go from 380 to 3 to 2.5. Okay, they just don't believe it right now, and so you see the 2 year in roughly this 380 range. It's pricing in basically 50 basis points of cuts towards the end of this year. So as that front end comes down, like that's profitable for the banks, plus an improving economy, um, less capital constraints. So the capital rules from a couple weeks ago could unleash another 5 trillion into the economy. It's like there are so many positive catalysts that are hard to ignore because the media just hates Trump, including the financial media, and they think that tariffs are like this boogeyman that's out there that's going to come snatch your children in the middle of the night. Like I have news for you, they're not.
Okay. Well, it snapped some jobs, though. Let's be fair. A lot of people got laid off because of exports, imports not working out anymore in the favor of the company. But I get it. The broad economy so far isn't still resilient. Mike, what are you not bullish on? Anything?
Oil, like they kind of the energy complex. Like I don't like any price spikes will be met with massive supply. Um,
Okay.
right? Like so, it just if you're owning these oil stocks, they're still going to make a lot of money, but I just can't see them working very well. I don't
So let's say we got a headline like Iran gets bombed again and oil spikes in the news. Is that a selling opportunity? Should you sell the
absolutely,
news? Yeah.
absolutely, exactly right.
Okay.
There, utilities have had like a very good run. I'd probably lighten up a position there. Not really bullish healthcare. I think with RFK Jr. coming in, there's like a lot of unfriendly regulation that's going to come towards these companies. Not really. I mean, look, we'll see what happens to REITs if these rates come down, but like not really broadly real estate, not really bullish. Pockets, obviously, data centers, yes. Um, so that's
Well,
that.
yeah,
So
you sound like
you're
you're
defensive
long cyclicals. Are you? Yeah. So you're underweight defensives basically.
completely. Try to own almost none of them at the moment.
Okay. And consumer staples, I guess.
Out
Hmm.
zero ownership.
Okay, great. Mike, great talk. Thanks again. Where can we learn from you?
David, yeah, michaelleestrategy.com. You can Google me, Mike Lee Fox Business. I'll pop up right there. Um, Mike Lee Strategy on X if you want to yell at me.
All right. Well, you made a great call with CoreWeave 2 months ago, so people can check out the last interview once again. Link down below. I'm sure you'll make another great call today. So we'll follow up and see what happens in a couple months. Thank you very much, Mike. Take care for now.
David, you're awesome, man. Thank you so much for having me.
Thank you for watching. Don't forget to like and subscribe.